Hello, and welcome to my channel, The Entrepreneurial Mindset. My name is Jay Berman, and today's presentation is called Essential Accounting Concepts, Episode 2. Today's concepts come from my book, Is Your Business Idea a Good Investment? It's available on Amazon.com as a Kindle version only. To find the book, go to the Amazon search bar, select books, type in my name, Jay Berman, quickly scroll to my book to purchase, and by doing so, you support my channel and my work. Thank you. So today's essential accounting concepts, again, continuing from episode 1, the income statement. I will introduce you today to operating expenses, earnings before interest and taxes, also called EBIT, interest, taxes, net income, also called net profit or net loss, and break even. I highly recommend, if you've never learned how to write or produce spreadsheets, that you learn Microsoft Excel or Google Sheets. So what are operating expenses? They are the costs of operating a business. They can be recorded daily, weekly, monthly, or yearly. The most common operating expenses are employees, their salaries and benefits, benefits being things like health, dental, group life, those type of things. Office space, if you run your business outside of your home, you may want to pay office space, pay office rent, marketing and advertising expenses, equipment leases if you need equipment, there's legal fees perhaps, insurance, depreciation of equipment and vehicles like a car or a truck, and of course communication, your cell phone, internet access. And again, these are generic operating expenses. They can be different depending on the business you're in and the industry that you're competing in. So earnings before interest and taxes, EBIT, it's also called cash flow, operating income, operating profit, or operating cash flow. And it's a pretty simple calculation. So from episode 1, you've calculated to gross profit. So now you take your gross profit, minus your operating expenses, and you get your earnings before interest and taxes. Now, interest on the income statement, only the interest that is paid to your banks is recorded on the income statement. Okay, just the interest. Now, the balance sheet is where you will record the principal that you borrowed. In other words, the original amount of the loan, and also any remaining principal related to that loan or those loans. And then on your statement of cash flows, you would record the principal payments recorded under financing activities. And in future videos, I'll discuss what is a balance sheet and statement of cash flows. But just understand that, you can see how all three financial accounting statements, the income statement, the balance sheet, and the statement of cash flows, are connected to one another. But just to reiterate, only interest is recorded on the income statement. Then the next thing you need to record is taxes. That's the business, company, or corporate income tax you pay to the government, whether it's local, your city, your county, your state, and of course federal. I recommend you check with your local and state government's Department of Revenue for more information on business taxes. And I also recommend that you become familiar with the Schedule C, which you can easily download from the Internal Revenue's website, irs.gov. And then the bottom line is your net income, also called net profit, or it could be a net loss. That is the last or bottom line of an income statement. So you take your earnings before interest and taxes minus any interest you pay to the banks, any taxes that you need to pay to the city, state, or federal government, and that equals your net income. Now you can also have a net loss, which means that would be the amount less than zero. So it would be a negative number. You may also you might break even. In other words, your net income equals zero. You record the net income or net loss on the balance sheet under retained earnings, which again, I will discuss in future videos. And then under the statement of cash flows, you record net income under operating activities. Again, here's another example where something that you record on the income statement also connects you to your balance sheet and your statement of cash flows. And this is an example, a generic example of what an income statement looks like. So you can see, starts off with revenues, cost of goods sold. Again, only if you're selling actual goods. There's your gross profit, then your operating expenses. Again, these are all generic. Owner salary, employee salaries, office rent, marketing, advertising, insurance, legal fees. You add up all your operating expenses. Oh, excuse me. And then you get you minus your operating expenses from your gross profit. So there's your earnings before interest and taxes. You minus your interest, you minus your taxes, and then your bottom line is either a net income, net loss, or perhaps you broke even. And that's all I have for today. Any questions or comments, use the comments section below. Subscribe to my channel for more educational content about entrepreneurship. And thank you for watching.